Hello, everybody. We are back. I have a busy day today. Let's go ahead and hop right in. I got to do a few house cleaning chores here before we start class. I know a lot of people who are not enrolled in the class watch this class, and it helps them with whatever studies they're in, or sometimes people are just interested in the subject. So this is for you. If you would like the handouts that we use in this class, don't leave me a comment on YouTube. I don't read those YouTube comments that often. Every now and then I'll go look at one, but I don't check those comments every day. If you want the handouts, send me an email address, and maybe they can put my email address up there. It's always at the beginning of the lecture. But send me an email address and ask for the handouts, and be specific that you're asking for the Accounting 2 handouts. Okay, the Accounting 2 handouts, because I have an Accounting 1 class as well. All right. The other thing that I get asked sometimes is, how do we know when you update your lectures? And I'm going to put this up again because some of you have asked me this via email. The best way to know if we are making new videos is to go, if you're on Facebook, go to that Facebook page and like it. And then I will post when we have updates on the videos. Okay, so I don't spend a lot of time reading the comments on YouTube. So if you write something there, I'm probably not going to see it. Okay, all right. Let me go through my list. Okay, let's go over Quick Study 1612 right now. Okay, I wanted you to read a few pages, and I wanted you to do Quick Study 1612. Is that correct? Okay, all right. Let's go ahead and take a look at that. I'm going to go ahead and just put it up there so we can kind of look at it as we talk. Oops, I smeared my ink down there. Okay, which of the following three competitors are in the strongest position as shown by the statement of cash flows? And then analyze and compare the strength of Moore's cash flow on total assets of that of Sykes. Okay? Well, you can see down here that this is their net increase or decrease in cash. Okay? And Moore and Sykes and Critch have 36,000, 26,000, and 25,000, respectively, increase in cash, right? But if you look at how their cash flows are comprised, then we immediately see a problem with Critch. And we talked about this last lecture. Your cash flow from operations is a number that investors and external readers focus on. You should have your operations to fund your business, right? To cash your business, or it should be a very important part of it at least. And their operations are not providing any cash, they're actually costing $24,000 cash. So there's no question that Critch is in the worst position. All right, okay. What about these other two companies? I would probably say, if push comes to shove, that Moore is in a little bit better position. And the fact, but it's very similar. Their cash flows from operating activities is a little higher. They were able to repay some debt. Both companies bought some operating assets, which will hopefully in the future contribute to them being able to, you know, why do you buy operating assets? Why do you buy those sort of things? To hopefully help you generate revenue in the future, right? So these are definitely the two strongest. An argument could be made, you know, on which one of those are stronger, but this is definitely the weakest, Critch, correct? Now that reading also talked about your operating cash flow on assets ratio, which is just your operating cash flows divided by your average total assets. And if you can read my numbers, which got smeared a little bit, that's 8.9%, 9.6%, and negative 8%, okay? Again, these are very similar. This is definitely weaker, okay? Does that make sense? Okay, that is about all we're gonna do on Quick Study 1612. Is there any questions?
So which one's the strongest?
Well, again, I don't know that we can definitely say of these two which one is the strongest. This one has a higher ratio, but I do like the fact that this one has paid down some debt but we don't even know. Maybe this one doesn't even have any debt. I think this is a situation where there's not a clear winner. These are definitely stronger than this one, okay? But I think we'd need to see more information. They also, you know, this has higher operating cash flows than this one, but it also has more assets, right? So no clear winner, I don't think, between these two, except that they're both better than this one, okay? So, all right, questions on that? Okay. This is something kind of unique that I do, okay? I really feel like in Accounting 2 classes, we don't talk enough about the interpretation of cash flow statements. Our objectives in this class really are to focus on the mechanics of doing a cash flow statement, okay? And we don't work on analysis of it, interpretation. What does it all mean? So what I have done is I actually, this was lecture 221. After this lecture, I actually have a bonus video. It's like an extra on a DVD that you purchase, right? It is a bonus video where I talk about the interpretation of cash flow statements and how to analyze them. Now, I realize that what I'm about to say is immediately going to turn your brains off here. There is nothing in that bonus video that you guys are responsible for on the test. Well, and let me say that differently. Everything you're responsible for on the test is on the other videos, okay? I mean, I restate some of the things that I've said before on this bonus video. But I do, believe it or not, there are people who watch these videos who are not enrolled in the class who want to know these things because it's helpful for what they're doing in their classes. And we taped a really nice segment on analysis and interpretation of cash flow statements last year. It was not for Accounting 2. So what I have done is I thought it would be good to have at least in the sequence of these, okay? So you guys don't have to go watch it. I realize most of you probably won't. But for those of you at home who watch these, if you want to watch that, it's clearly labeled as bonus video over cash flow interpretation or something to the sort, and it's in the sequence. And in the description to this video, you will also see a URL link where you can click on that to watch that. Does that make sense? Okay, so something kind of unique that I do. All right? Okay. The other piece of homework that I believe I assigned was, what was it? Tell me. Foxboro. Okay, I'm going to do something unique here too. I am going to simply lay the answer up here. Okay? I am going to simply lay the answer up here for you to look at. I am not going to go in depth through walking through the step-by-step process of how I reached this conclusion of that being our cash flow statement. Okay? However, come off that if you would, please. What I have also done, and this is a little unique too, is I have made a little bitty video, and it's probably about 8 minutes long, where I very slowly and specifically walk through solving the Foxboro cash flow statement. Okay? And the URL to get to that is in the description of this video as well, very clearly described as such, and it's probably in the sequence as well. But I know for sure that the URL to the Foxboro solution or the answer to the Foxboro cash flow statement, that URL will be in the description to this video that you're watching. Does that make sense? So if you're like, well, Dave, I'm looking at this and I don't see how you got that. I don't want to spend class time today, 8 or 9 minutes, walking through that. Okay? If you want to watch that, it is available to you and accessed in the ways that I just told you. You with me? Make sense? Okay, we are officially done with going over material for the cash flow, chapter 16, cash flow statement. However, here is the way. Do you know that? Remember that we did not have a complete cash flow statement on your last test? Okay. Well, I am not going to have cash flow statement information on the next test. Here is the way I'm going to assess your knowledge on if you can do a complete cash flow statement. Listen to me, this is very important. I have a connect assignment or mini project that is worth 15 points. You are going to go out to Connect and do a complete cash flow statement. Now here's what's really important. This is worth 15 points towards your final grade. It is not accumulated with your other Connect assignments. You see what I'm saying? It is not part of that. It is separate. So it is worth more than your usual Connect assignment. So if you're in the habit of blowing off Connect assignments, don't blow off this one. Because I think I call it like a mini project to try to separate it a little bit. But it is worth 15 total points towards your overall grade. And what it basically is, think of it as a take-home, open book, cash flow statement quiz. You with me? Worth 15 points. So that is out there on Connect. Has anybody seen that?
You have a mini test
Do I say mini test?
in the syllabus.
Yeah, I don't know if I call it a mini test or what. The main thing I'm trying to specify is that it is not included with the rest of your Connect assignments in how I grade it. It is a totally separate, standalone, 15-point assignment. You with me?
And when's it due?
I don't know when it's due, but even if I did, I don't want to tell you on camera because it messes up the people at home. So check the due dates, folks at home, as always, to when that's due. And if you guys, I know it's at least 5 days from now. Okay, but maybe next time before the cameras roll, somebody can clarify. I don't remember, to be honest with you, because I put it out there last Friday. Okay, questions? A lot of housekeeping stuff today. All right. Now what we are going to do is talk about Chapter 17. Okay? Now, Chapter 17 is on financial statement analysis. Financial statement analysis. Well, let's see how we can get to. There we go. Okay, financial statement analysis is Chapter 17. You can come off that. This is such an important chapter, okay, as far as for your use in real life. I feel a little bit guilty because we're only going to have a couple of class periods over financial statement analysis. This is a subject we could easily spend weeks on, if not a whole semester, if not a whole year. If you get an accounting degree, you probably will be required or highly encouraged to take a class on financial statement analysis, okay? Very important. I think when I was going through school, to be honest with you, I think we did a very poor job of learning this, okay? But this is such an important concept. If you know how to analyze financial statements, if you know how to look at trends over time, it is extremely beneficial to your business. Okay, and I'll give you some examples why as we go through this lecture. There's so much material to cover in accounting too that there are subjects like this one that we almost just kind of touch on, right? Now, if you take managerial accounting, we'll go into more depth in this area, okay? Same thing with cash flow statements. We actually go through cash flow statements again in managerial accounting. But for financial statement analysis, we're only going to briefly introduce it to you at this point. And you've actually been briefly introduced to a lot of things already, all right? Okay, what is financial statement analysis? What is financial analysis? Okay, I got a picture of a baseball player here, okay? Did anybody play baseball in high school? Okay. Okay, you can come off of that. Baseball has a ton of statistics that they keep track of. Is that correct? ERA, batting average, slugging percentage. What are some others? On-base percentage.
Whip.
Whip? What's whip?
Yeah, walks plus hits per inning.
Walks plus, I've never heard that one. Walks plus hits per inning. But they have all of these ratios. Now, you played in high school, you two? Did you have somebody who kept track of this stuff for the team?
I'm sure, yeah.
Yeah, I'm sure you did too. Coaches always keep track of this stuff. Why would a coach want to have that information? because it's going to help them make better decisions, right? Okay, Michael, for example, they could keep statistics for you, and they could compare it to how you were doing last year or how you were doing the early part of the season, right? Or what they could do is, let's say you played first base. They could compare it to the statistics gathered for other first basemen, right? Okay. Or they could compare it to maybe statistics for whatever league your team was in, right? Or there's also certain rules of thumb that are used in analysis. For example, what's the rule of thumb about your batting average? If your batting average is what or higher, is it considered pretty good?
Your playing weight.
Your playing weight? I've never heard that. I've always heard just 300.
Yeah.
If you're batting 300 or better, that's generally considered pretty good. But it's just a rule of thumb, right? Okay? So, but the same reason and thinking process for keeping these different created ratios and statistics for baseball players also applies to the financial analysis that we do for businesses. Going to the slides, it's kind of, it helps us transform data into tools that will help us to analyze the situation more efficiently and more effectively. It reduces the uncertainty, right? If I go, well, I think Michael's not batting as well as this year as he did last year. Well, why don't you get the statistics? Let's gather his batting average, right? And let's compare it to what he did last year, okay? So it's the same sort of thought process, okay? Now, and ultimately, as I said, it helps users make better decisions, okay? Now, just like those comparisons were made with you, Michael, we have these same sort of comparisons with businesses. We have to be able to interpret these statistics, and we have to have standards of comparison, right? It's not enough just to have a number, right? Okay? It's like when I go to the doctor and they do like a cholesterol test and they go, your cholesterol is 39. And I'm like, well, okay, is that good or bad? I don't know, right? Okay? So you have to have standards of comparison. Well, Michael, we said that we could compare you to previous years, right? That is kind of analogous to intra-company comparison, okay? Comparisons within the company in past periods. Or competitors. Like I said, I might compare you to other first basemen, right? That's analogous to this one right here, this standard of comparison. Now, obviously, it has to be a meaningful comparison. In baseball, you wouldn't want to evaluate a pitcher's batting average compared to that of a designated hitter, would you? Because those are two different positions, right? Well, I wouldn't want to take the ratios of a steel manufacturing company and compare them with the ratios of a flower retail shop, right? Does that make sense? No, it doesn't make any sense. So that leads us to this third area of comparison, which is industry. Sometimes different industries will put out these monthly magazines or monthly periodicals or quarterly that gather anonymous statistics from the industry so that you can compare how your specific company is doing in that industry. Does that make sense? And then, of course, as there are rules of thumb or more general guidelines in baseball, like I said, a batting average of 3.0, or if you bat 300 or more, that's considered good. There's these rules of thumb or guidelines in businesses as well. For example, a rule of thumb is that your current ratio, you want it to be at least 2.0. I've heard that, okay? So, but do you see how these kind of relate? It's a lot like sports statistics, okay? It's a lot like sports statistics, all right? Okay, we're going to talk about three main tools of analysis. We're going to talk about horizontal analysis, where we look across time at a company's performance. We're going to look at vertical analysis, which is their financial condition and performance at a specific time compared to a base amount. And then we're going to look at these ratios. And we have talked about these ratios before. Even in accounting 1, we introduced the current ratio, the acid test ratio, inventory turnover. We just talked about the operating cash flow and assets ratio when we went through Quick Study 1612, right? So we're going to kind of talk through these today. Let's talk about horizontal analysis, okay? Now, horizontal, we call it, remember horizontal is left and right, like the horizon, right? Okay? So think about that as we go through this. Horizontal analysis is sometimes called trend analysis, and it shows the changes between the years in dollar and percentage form, okay? Well, first of all, we need to figure out the dollar change, which is pretty easy. We just take the analysis period amount minus the base period amount, and that's how much it's changed. Pretty simple. Then we want to figure out the percentage change. And we do that by taking the dollar change divided by the base period amount. Let's look through some examples. Okay, cash from 2013 to 2014 went up by 15,000. Okay, so the dollar change was a 15,000 increase. Well, what was the percentage increase? Well, we take the dollar change of 15,000, or 90 minus 75, divided by the 75,000 base period amount, and we have a percentage increase of 20%, right? Okay. Another way of saying that is if you took 1.20 times 75,000, you would get 90,000. Is that correct? There was a 20% increase. Okay. What about if the numbers are going down? Okay, accounts payable went down from 32,000 to 28,800 from 2013 to 2014. Well, the dollar change there is negative 3,200, right? Or 28,000 minus the base period amount of 32,000, and then we divide that by the base period amount. Okay? And in this instance, we have a 10% decrease.
So do you want to decrease in that situation? Is that better?
Well, perhaps. I mean, we need to know more information, okay? But, yeah, all things being equal, yeah, it's nicer to have lower liabilities. But our accounts payable decreased by 10%, right? And there's certain things you want to increase, right? Like your salary. And there's certain things that you want to decrease in life, like your weight, correct? So you're right in knowing that we need to know which way we want it to move, okay? Now, the book talks about horizontal analysis where there's more than just one or two periods being analyzed. Let me come off that before I go to this example. This is one of my main complaints about the way that Accounting 2 textbooks teach financial analysis. They always do their trend analysis based on this year versus last year, right? Well, that's just not the most effective way to do analysis, okay? Think about your financial statements that you do. Don't you do financial statements for this year and then you have last year, and isn't that usually the report that you issue? Well, trend analysis is not real strong if you only use 2 data points. Here's the example that I like to give, and I may have said this in Accounting 1, you might remember it. But I have a son who is 18 years old. He's a senior, okay? Well, when he started in kindergarten, they take school pictures in the fall, and then they take school pictures in the spring, okay? Well, my wife has a book that she bought years and years ago where she puts his fall school picture on the left side of the book, and then the spring one on the right, and that's kindergarten. Then she turns the page and does the same thing with first grade. Fall first grade, spring first grade, right? And she's done that each year, correct? Well, if you open up that book and look at any 2 pictures of my son right next to each other, like fall of 4th grade versus spring of 4th grade, he doesn't look that different, right? Maybe his hair's messed up a little different. Maybe he's got a tooth missing. But it's not that much different, right? When you're looking at 2 data points that are right next to each other. However, if you look at his kindergarten picture and compare it to his senior year, holy cow, This kid has changed, has he not? But you don't see those things. You don't see those things if you are looking at trend analysis over too short of a period of time. Okay? And too often times in accounting classes and accounting education, they're looking at way too brief of a time period. And then they're calling it a trend. You with me? Give you another example. Okay? Take a look at the Elmo here. All right? Here's something else that I do. Okay? Over time, I have this little iPhone app where I weigh myself in the morning and I input it. I don't do it every day, but maybe, twice a week or something. Okay? And I have done this for, I don't know, 4 or 5 years since I've had an iPhone. Well, you can see trends over time, right? Now, my weight has actually gone down over 5 years, okay? But let's say that I was looking at a trend, and let's say that this is over 5 years. And let's say my weight was doing this. Okay? Let's say my weight was doing that over 5 years. Well, I am clearly getting much heavier, am I not? Okay? And that should I should be concerned about that. But if I'm just looking at a brief period in time, can you really tell that this is going on? Can you tell that Krug is getting fatter? Heck, what if you're looking at that? Hey, you're doing a great job, Dave. Well, you're not really doing a great job, Dave. You see what I'm saying? And I don't believe that people in business do a very good job of financial statement analysis. Okay? When I go into a client, I figure out some of these key ratios: current ratio, gross margin percentage, acid test ratio, inventory turnover, and I compute them at the end of each month, because I do monthly financial statements, and I do it for the past 4 years. And I tell you what, there you see some trends. Okay? There you see some trends. What cracks me up is it's not even that difficult to do this. And many companies do not do it. They don't do it. I have a friend who owns a business, has 40 or 50 employees, and I ask him, and I describe financial analysis to him, and I ask him, do you do this? And he says, I do not do this. I go, why do you not do this? Do you not understand how to do this? I understand it. It's not that hard. It's not hard to figure out a current ratio, is it? I don't do this. I'm very busy. And I say, but here's what I know about you. I know that you're in my fantasy football league, and I know you spend a lot of time perusing football statistics because you need to figure up a third running back because you're weak in that position from your analysis. Do you know what I'm saying? I go, you spend more time on your fantasy football analysis than you do this company that you own that has 40 or 50 employees. Is that not crazy? And we do the same things in our own lives, right? We worry about fantasy football more than our weight going up or whatever. But this is so important. I'm getting on my soapbox today, I apologize. Okay? Here's another thing that has happened. A few years back, we had this financial crisis, and what was happening is banks had loaned businesses money, and these businesses could not pay the loans back, and so they had to be written off. Okay? I had a client that called the consulting company that I work with sometimes, and they wanted us to go look at this construction company who was not paying their loan back. Their loan was $2 million that they owed this bank. Well, what we found out was the commercial the commercial loan officer, here's what they were doing. Every year they got the financial statements. They'd pick them up and look at them, and then they would look at last year's, and they would look mainly at the bottom line, the net income. They made money this year, they made money last year, let's give them some more money. Well, we did a much more in-depth analysis of these ratios over the last 4 years. This company was clearly trending downward. It was clearly getting more unhealthy each month. Bottom line was that bank wrote off a $2 million loan. because that company went out of business. This specific bank was not doing a good job of financial statement analysis. They were looking at this year versus last year, and that is not financial statement analysis, at least effective financial statement analysis. Does this make sense? A lot of you will own your own business someday. These are tools that you should utilize. Wish we could spend more than just a couple class periods on this. Back to horizontal analysis, though. Let me give you a real kind of simple example, all right? Okay, you've got a married couple here, right? And here is the raw data of their combined salaries over the last 5 years, from 2010 to 2014. And here's the raw data as far as their total household expenses. Well, you can see that their combined salaries have increased over that time period, and you can see that their household expenses have as well. However, let's apply horizontal analysis, as your book talks about, to this situation. If we do horizontal analysis of the combined salaries, what we do is we take 104,000 divided by 100,000 and we get 104%. We take 106,000 divided by 100,000, we get 106%, and so on, right? And of course, your base year, you take 100,000 divided by 100,000, you get 100%. And since I had a base year of 100, you know that these numbers are right, okay? 104%, 106%, 109%. 2014 combined salaries, 114% of 2010 combined salaries. You with me? Now let's do the same with our household expenses. Again, 78,000 divided by 78,000 is 100%. 80340 divided by 78,000 is 103%, and so on. Well, the horizontal analysis tells us something, doesn't it? The household expenses are increasing at a faster rate than the salaries combined are increasing, correct? So that's something that needs to be addressed, and address it while it's still not that much of a problem, okay? Financial statement analysis allows us, if we do it effectively, to identify problems before they're so big of a problem that it's too late. This bank that called us in to analyze this company, by the time my company, the consulting company I work with was called in, it was too late. The patient was just about dead. But if they would have been doing financial statement analysis over the last 3-4 years, first of all, they wouldn't have kept loaning them money. And secondly, they could have maybe corrected the situation without the company going bankrupt. Are you with me? Okay. That's a quick example of horizontal analysis. All right? Powerful tool. But do you see how this trend down at the bottom part here would not have been as readily identifiable by just looking at the raw data? Cool? Let's take a look at vertical analysis. Now, vertical is up and down, right? Vertical analysis is when we focus on the relationship on a financial statement at a given point in time, okay? And we express each item as a percentage of a certain amount, okay? The base amount that we use for the balance sheet vertical analysis is total assets. The base amount that we use for the income statement is usually total sales. This is going to be best illustrated with an example. So let's look at a fictitious company here, Highland Corporation, for 2 years. And let's do common size statements, in other words, vertical analysis. Okay, well, here is their 2 years of data. Just looking at 2 years for time's sake here. Okay? Well, we're going to take every number divided by the sales for that year. Okay? So, this 69.2 is achieved by taking the 360,000 divided by the 520,000. Okay? This 65.6% is a way of saying that cost of goods sold for 2013 was 65.6% of sales. And we got that by taking 315,000 divided by 480,000. And you do that for each item. Okay? Now, this is just a real quick example, but what conclusions can we draw? Well, one thing that would jump out to me right here is I would do horizontal analysis of our vertical analysis computations. Let me say that again. I would do horizontal analysis over time of those vertical analysis computations. And one thing that would alarm me a little bit is their gross, oops, I circled the wrong one. Circled the wrong one, sorry. This is the one I meant to circle, okay? One thing that would alarm me here is that their gross margin percentage declined from 34.4% to 30.8%. That's not good, is it? That's a big decrease in gross margin percentage. Okay? So I don't know what's happening there, but it tells us where we need to investigate. Is the cost of our goods that we sell increasing and we're not able to pass those on to the customer? Or we're just not passing them on to the customer, or what? But our margin is eroding. You see that? Okay? We take everything divided by sales for the year to get all of these numbers. As I said, horizontal analysis of vertical metrics is a powerful tool. And perhaps you see that gross profit percentage is declining over time. Or if you do net income divided by sales, it is declining over time. Okay? When I did this, this is horizontal analysis over time of a vertical measurement, isn't it? And you can see that whoever this person is getting quite large, right? Okay? Address the situation before they have a heart attack and die, right? Okay? Seriously, I've said this before. We want to try to solve problems while they're still solvable. That's why we use these metrics and why we use this analysis. Okay? Back to the computer. Some real-world examples of when this was used. Subway did this sort of analysis back in 2008, and they realized they had an advantage in their margin due to their low food costs. And what they enacted was the $5 footlong campaign. And they did have a decrease in margins, but from their analysis they knew, or they suspected, that it would be more than offset by volume increases, and they were correct. Total net income increased. Now Quiznos tried to follow suit, but they had a lower gross margin because their food costs were much higher. They tried to do the same sort of strategies as Subway, and their margins eroded, and they could not make them up in increased volume. And a lot of franchises actually went out of business, okay, including the one that I like to go to. Okay? So this is a quick example of how this has been used in real life. Okay? On a balance sheet, we do vertical analysis, but we take everything divided by the total assets number. Okay? That is the base number we use. And you can see this right here. Every one of these numbers were divided by total assets to get whatever number it is. Okay? Now something like this is so much easier if you know how to use Microsoft Excel. Okay? If you take managerial accounting from me, you'll learn how to use Microsoft Excel if you don't know already. Okay? And then of course we can a lot of times use this, make a circle graph out of some of this data as well, and that can be used in our analysis purposes as well. Now let's talk quickly about some of these ratios that we utilize. Now I'm going to have to zip through this, but you can look through these slides and you can look through the chapter a bit. Okay? Now, too much of our attention, it seems, in accounting education is on how do you compute these ratios, where I wish we could instead focus on interpreting the ratios. You with me? Keep that in mind as we go through these. Okay, there's four primary categories of ratios. There's those that have to do with liquidity and efficiency. Those have to do with solvency, those with profitability, and those have to do with market prospects. And some of these we actually addressed back in chapter 13. Do you remember when I had you do that connect assignment where you read those pages and you did that quick little connect assignment? Some of those were addressed back then. Let's talk about liquidity and efficiency. This is such an important set of ratios. Your current ratio, your acid test ratio. Remember those ratios? Those measure your ability to pay your debt in the short term. Your accounts receivable, your inventory turnover, those sort of things. Let's look through these. okay? Again, short-term creditors like to focus on this when analyzing a company because this measures our ability to pay our debts in the short term. Remember the current ratio, our ability to pay short-term debt? We do current assets divided by current liabilities, right? This is a very important ratio that I always compute for my clients, and we look at it over time to see if it's deteriorating. There is, and you can see how you just divide those numbers and you get some amount, okay? There's also the acid test ratio, which measures the same thing as the current ratio, that is the ability to pay short-term debt, but it does it in a little different way. It recognizes that not all current assets are equal, right? If you have $20,000 worth of cash as your only current asset, you are in a much better position to pay your short-term debt than somebody who has only $20,000 of current assets, but it's all in inventory. You see that? So the acid test says, no, we're only going to count in our numerator those what we call quick assets, those that are very liquid, such as cash, short-term investments, and receivables, okay? You can see the definition of quick assets down here, okay? Quick example of how this might be beneficial. We have 3 fictitious companies here, and I give you this information. Now, you folks at home, maybe you want to pause this real quick and calculate the current and acid test ratio, and then push play when you're done. But the current ratio and the acid test ratio lead us to different conclusions. As far as current ratio, company B has a healthier current ratio than A or C. However, a lot of their inventory, or a lot of their current assets are inventory and prepaid expenses, which are not nearly as liquid as cash, right? So if you look at the acid test ratio, company C clearly has the superior ratio because they have a lot of their current assets in those liquid assets of cash, short-term investments, and receivables. Does that make sense? Okay. What about accounts receivable turnover? Okay, come off that for a second. Anybody here worked as a server in a restaurant? Okay, Jeremiah. Daniel has too. What you want to happen when you're in a restaurant is you want your table to turn over quickly, right? You want people to come in, you seat them, they order their food, you bring their food, they pay their bill, they tip you, and then they leave and somebody else comes and fills that spot. Did you ever have campers?
Yes, they're terrible.
That they come in, they eat, they pay, they maybe tip, and then they just sit there and talk about the Royals for 2 hours, and there's people at the door that want to sit at that table, but they're sitting there talking. Turnovers in football and basketball are bad things, but there's certain sorts of turnover that we want. We want our table at the restaurant to turn over so we can get more tips. We want our receivables to turn over. We want them to be collected quickly. We want our inventory to turn over. We want to buy inventory, it's sold, we have cash, we buy more inventory, it's sold, we have more cash. We want it to turn over like this. These next ratios up here, which I'm not going to read each computation because of time, but these measure those factors: accounts receivable turnover. How many days uncollected in sales do we have? How long is it taking our receivables to come in? Are our receivables slowing down? Inventory turnover. How many times does our inventory turn over in a year? What is our days sales in inventory? If we stopped purchasing inventory, how many days worth would we have to sell before we ran out? Okay? Very important. Now let's talk about solvency ratios, and these are more for the ability to pay debt in the long term. You've got the debt ratio, the equity ratio, the TIE ratio, the debt to equity. These all pretty much measure the same thing but in different ways. The debt ratio, you compute your total liabilities as a percentage of your total assets. Now, for a company, is that something that they should know? For Johnson County families, is that something they should know? Maybe they can see their debt increasing over time. You have to pay that debt back eventually, right? Okay? So there's different ways to measure that. The TIE ratio takes what we call EBIT, which is your earnings before interest and taxes have been deducted, and divides that by interest expense. Now, all things being equal, do you want your TIE ratio to be high or low?
High.
Here's what I always ask.
You want high?
Well, a high ratio would mean a high earnings and low interest expense. A low TIE ratio would mean low earnings and high interest expense. So now let me ask the question again. Do we want this ratio to be high or low, all things being equal? We want it to be high. We want our numerator to be high. This is another way of measuring that. And of course, you could go your debt to equity ratio as well. All right, quickly let's talk about ratios that assess profitability. I know we're about out of time here. We'll go a couple minutes over. We've talked about these as well, even in this presentation that we've done. Gross margin percentage, profit margin, ROA, return on assets, okay, return on stockholders' equity. Okay, let's talk about profit margin. Profit margin is calculated by taking net income divided by net sales. And this just describes how much of each sales dollar actually is going towards net income, okay? Now, we talked about that a little bit in some of the previous slides when we were looking at margins. We also talked about gross margin ratio. The gross margin ratio is calculated by taking the gross margin divided by sales. Now remember, gross margin and gross profit are the same thing. And remember that gross profit, or gross margin, is calculated by taking net sales minus your cost of goods sold. But this is how much of each sales dollars is left after deducting cost of goods sold. Remember when we were talking about margin erosion? These two ratios, gross margin and profit margin ratios, are the ones that we analyze over time. Margin erosion, if these are getting less over time, that can be a real problem. Along with this is return on assets. Now this book calls this return on assets, but I also want you to be aware that there are some books that call this the ROI, return on investment. Okay, so if you ever see that term, know that it's the same thing. We compute ROA by taking our net income over our average total assets. Okay, and this measures how are we in generating income from the assets that we have. How are we in generating income from the assets that we have? Another way of saying it is as written there, it's the measure of the overall profitability of those company assets. Okay. Now, one kind of we want to maximize this ratio. We want this ratio to be high. Okay. Now, another way of looking at the ROA is as the product of two other ratios. There's the original ROA ratio, but we could also take a look at the profit margin ratio, which we discussed earlier, as well as a new ratio called the total asset turnover ratio. This ratio measures how much sales we are generating from our assets. Okay? So take a look at this. I think this will clarify it. ROA is also measured by taking profit margin, this ratio right here, times our total asset turnover, which is right here. And this kind of makes sense if you think about it, and you think about how those ratios are calculated, okay? If profit margin is net income over sales, and total asset turnover is sales over average total assets, well, we know from grade school when we multiply fractions that we can kind of cancel those things, and thus what is left is this original formula. Now, why do we go through this? Well, we go through this because business owners want to maximize ROA. They can think of this as we could do that by increasing our profit margin, the amount of net income that is generated from our sales, or we could increase our ROA by improving our total asset turnover, which is the amount of sales that we're getting from those assets and the efficiency of that, okay? So that can increase by either increasing this or this, or certainly both. Now there is the total asset turnover, which was introduced in the previous slide. Again, this reflects the company's ability to use its assets to generate sales. And then in this section is the return on common stockholders' equity. Okay, not the return on assets, but the return on common stockholders' equity. And we compute this by taking net income minus your preferred dividends. We want to get that out of there since we're just concentrating on common stockholders' equity, divided by your average common stockholders' equity. This is how well the company is doing in using the owner's investments to earn income. All right? Now, with this ratio and with all of the ratios, I really think it would behoove you to not just use these slides, but read through your chapter, read through the way that your textbook describes these, and they give you some examples in calculating these and what you would include and what you would not include. And I think that will be helpful if you do that before you do your homework or any of the assignments that I give you in regards to Chapter 7, or 17, I should say. Okay, a few closing thoughts. Now, the limitations of this is you obviously need to not just concentrate totally on ratios, but you need to look at trends in the industry. Maybe there's some big changes that are happening within the company. Maybe the economy is not doing well. There's other things you need to take in consideration as well. One final warning is you also need to, when comparing to other companies, they may have different methods of accounting. For example, we might use the LIFO method where they use the average cost method. So you need to make sure that you're making meaningful comparisons, okay? Okay, come off that a bit. I know that was a lot of information in a short amount of time. I wish they'd give me more weeks to teach accounting too, because it's very difficult to get all this information in time, okay? Okay, this is the homework I want you to do. I know it looks like a lot. These three are real quick, and this all has to do with the same set of data, okay? High probability of a homework check for you folks here, okay? I want you to do this homework, okay? Because we don't have a whole lot of time on this subject. I want to make sure we do what we can with the time we have. So take a look at your homework. Please do this. Okay, I know it was a lot today for you folks at home. If you need to watch it again or if you need to take some breaks by pausing during there, I understand. It's an important subject. I wish we didn't have to rush through it too much. You will revisit it again in your business education. Make sure you do that homework I just told you about, and we will see you next time. Bye-bye.